very nice to be here, everybody, and to just say a few words at the introduction of Professor Congdon's talk, and to say, by the way, if you don't know who I am, my name is Anthony Seldon, and I've known Professor Congdon for probably 3/4 of my life, so it's a great thrill to be here. He will explain in his talk how that relationship started. It wasn't that I was a particularly precocious schoolboy, it was that there was another link between us. So I run the university, have done for 2 years, have known about this university all my life, since its foundation in 1976, and hugely proud to be here, and very, very proud to be just saying these few words at the launch of this magnificent book, which I received him about 2 weeks ago, Money in the Great Recession. It seems to me that the Institute of International Monetary Research is a real beacon in the University of Buckingham. We're very proud indeed of it. Delighted that students are starting to flow this year with 14 master students, and no doubt doctoral students to follow, and building up in a very quick rate, I'm sure, to the full number of students. It's really an outstanding start. And few economists have had more influence in the last 40 years than Tim Congdon, and we're going to now be hearing from him. And Tim, thank you very much indeed. And a wonderful book. Who's read the book already? There you are, Juan Castaneda. There you are.
Well, Anthony, thank you very much for those kind words of introduction. Yes, the Institute is now 3 years old, but it's really got going, I suppose, in the last 18 months or so, particularly since Juan Castaneda has been director, and we're delighted to welcome the MSU students starting now, and more coming along in January. One of the most important things that the Institute can do is to publish new research, and that is really the purpose of this book. It is the first of what I hope will be a series called Buckingham Studies in Money, Banking and Central Banking. Now, I'm just going to say a few things about the Seldons. Of course, we're very lucky to have Anthony as the Vice-Chancellor. I don't think there is a single Vice-Chancellor in this country, or perhaps around the world, who's as energetic and as enthusiastic as Anthony is. And so the university is very, very lucky to have him. I know of the Seldons through actually more Anthony's father, Arthur Seldon. Arthur Seldon was one of the 2 leading figures at something called the Institute of Economic Affairs, which was one of the key drivers in what is called the Thatcher Revolution, in the drift or the change from a statist approach to economic policy to a more free market approach, which began, I suppose, in the late 1970s. And I was associated with that movement to some extent. And Arthur, enormously prolific as well, but he wrote, one of the first things he did at the Institute of Economic Affairs, I think it was in 1960, was to write a reply to the report from the Radcliffe Committee on Britain's monetary policies, banking institutions, and so on. And this Radcliffe Committee report was hugely important because it said essentially that money doesn't matter. It doesn't really matter what the government and the Bank of England decide on monetary policy, and you can have any rate of growth of the quantity of money, and the effects of this on the economy will be offset by changes in the velocity of circulation, so basically you could ignore it. What matters is we, economists as planners and people controlling the government spending and the budget deficit, we Keynesian planners and fiscalists. Now, these notions ended catastrophically in some boom-bust cycles in the 1970s and 1980s, which I commented on as a journalist and as a commentator in the city. And I said, money does matter. And that is the point of this book, which of course is a very important and revolutionary tract, and the more select the audience, the higher the quality. So, now, the point of this book is to say that the Great Recession was not caused by capitalism. It was not caused by things going wrong. Things did go wrong in the financial system. But it was not indeed, and this is where it's very shocking to say these things, it was not caused by bankers. No. Unanimous view around the world that it was caused by bankers. Not unanimous. No, it wasn't caused. What this book argues is that the fundamental cause of the Great Recession was that the state, through its regulatory agencies and central banks, changed banking regulation in late 2008 in a very foolish way that had the effect of causing a collapse in the rate of growth of the quantity of money, which then caused the worst of the Great Recession. So, as with Milton Friedman and Anna Schwartz's analysis of the Great Depression in the early 1930s, it wasn't capitalism that was to blame, it was a blunder on the part of the state. Milton Friedman and Anna Schwartz criticized the American Federal Reserve, and I criticized the American Federal Reserve and the Bank of England and the European Central Bank and the regulators as well. That's why the book matters. Now, having said that, I'm in fact only the editor, and we all agree, all the contributors agree, that something of this sort needs to be discussed, but I don't want to upset you and disappoint you. It's written by, I think it's 7 or 8 economists, I forget the number now, 7 or 8 economists, and as ever with economists, we don't always agree. So there are other points of view expressed in this book. I of course believe in freedom of speech, and one of the great things about this university is that it comes top in the country for freedom of speech, and long may it continue. And so there is a debate in this book about these very important issues. If you're doing the MSc at this university, with this institute, you are in for a treat. We will be doing things, saying things, teaching things that are topical and important, and relating to what's going on in newspapers, relating to what's going on in the world at the moment. I think at that point I'm going to say thank you very much. Thank you for coming. Anthony, thank you for your kind words of introduction. And let's all hope we have a good time on the MSc course this term and next year. Thank you.
Thank you, Tim. I mean, if you want to, please.
Well, questions are welcome, of course.
Yes, that's why I just wanted to
Absolutely
open a round of questions. Perhaps if I can start with a question, Tim, if you don't mind.
Please.
Unless there is a question from the floor, please.
Well, just one before I go. So there is Robert Skidelsky, who is Keynes's official biographer, who I've worked with for many years. Delighted to see one of Tim's great academic qualities is the breadth of view that he's willing to entertain. Robert Skidelsky has written about what Keynes would have thought of the events of 10 years ago. Do you think that Skidelsky was wrong in what he writes about Keynes, or that Keynes was wrong, or both, or neither?
I think Keynes is a brilliant man. And there was a very interesting exchange with Robert actually at the lunchtime. I think one of us was actually there, you were there, in London, where I said money always matters. And he said that Keynes claimed that after 1933 money didn't matter. And when I made this statement that money always matters, I got this heckling from the back, well actually about sort of 3 feet away, Robert Skidelsky, religion, you've got religion. At which point I said, no, on the contrary, what I'm interested in is evidence. I'm interested in scientific method, I'm interested in evidence. And I also was a little bit rude to him and said, come on, you know perfectly well I put together the only serious evidence in your chapter. It's the table on fiscal policy. I didn't say it directly, but that's what I implied. And at this point, well, perhaps I shouldn't say these things because in a sense this camera's rolling, but Robert said something very strange. I mean, it's all recorded. He said, but the evidence isn't conclusive. No, my dear fellow. Look, the scientific method is about evidence. It's the precise opposite of religion and faith. And, you know, I think at that point, well, I hope Robert rethought his position.
I'm sure he did. And you're very, no one is more persuasive than Professor Congdon.
Thank you. Any other questions?
Yes.
Yeah, please.
Just,
go ahead.
do you believe that the incentive structures of private banks or even shadow banks has changed now that it's been almost a decade since the crisis? Or are they still existent in the same way they were before the crisis?
Well, the shadow banks are a nuisance. One of the arguments in the book is that the main commercial banking system in the United States was profitable all the way through, and that there was no need for all the extra capital and the regulation. But the shadow banks, certainly some of them had major trouble. And I can see that in a full analysis there needs to be further discussion and further analysis of the shadow banks. One of the reasons, by the way, why America developed the shadow banks in really for 20, 30 years up to 2007 was precisely because bank regulation in America has been very strict for decades, in fact going back to the policy reaction to the Great Depression. So the notion that in some sense the American banking system was unregulated or loosely regulated in the run-up to the crisis is completely wrong. In fact, the shadow banks came into being precisely because the mainstream banks were very tightly regulated. And in fact, in the mainstream banks, there were hardly any problems in terms of, there was indeed high loan write-offs relative to the past for the main banks, but they remained profitable all through the crisis period.
Thank you.
Any further questions? No? Yes,
Yes,
please.
And what do you think about privatization and privatizing central banks? Do you think it will help solve some of the issues?
Well, this is a very important question. I've actually wrote, it's actually again for the IEA, Ministry of Economic Affairs, something back in 2009, saying that one of the things that we want to consider is privatising the Bank of England. Now, one of the reasons for this is that when the Bank of England makes a loan to banks, because the Bank of England is government-owned, it appears to be government money that is being lent. It is taxpayer money that is being lent. And the allegation is then made that this isn't fair, that there's all these bankers who've had huge salaries and all the rest of it, and they're supposed to be doing all sorts of wicked and evil things. In some cases they were doing wicked and evil things. And then, despite all of that, they receive government money. Okay. So one of the reasons for having a privately owned central bank would be to refute this idea that it's always government money that's at stake when there's a so-called last resort loan from the central bank. Can I just say on this front that in my view it's very important that the central bank should be a bank. It should have the power to make loans to banks that have got a cash flow problem themselves. And well, this is in here, it's in this book, it's in this 2009 study I did called Central Banking in a Free Society. I point out, I think this is true, that Mervyn King didn't want the Bank of England to make such loans. He didn't want to do so at all. Now, he might dispute that. Well, perhaps at some future date we might discuss that. I don't really know. What is certainly true is that the Bank of England in this crisis did not make large continuous loans to any British bank. It charged very highly for any such loans it did make, and it made sure that any such loans didn't stay on the Bank of England's balance sheet. Contrast that with the European Central Bank. The European Central Bank made huge facilities available to Eurozone banks, and it didn't charge very much for them. In my view, the disparity, the inequality between the way the Bank of England behaved to British banks and the way the ECB behaved towards Eurozone banks was quite wrong and very unfair.
Please.
Tim, I'm interested about the question of capital requirements at the banks. Is it your view that really you could leave that entirely to the market? Or whether you think that, you obviously think that too many requirements have been added recently in terms of capital requirements. So, that is clear. But in general, are you in favour of some regulatory approach,
right,
just a more generous one, or are you thinking that actually there is a sort of market process which would be stable enough and so on to give us efficient results? I was intrigued by. I'm not a monetary economist, I should say to everybody else in the room. I'm a microeconomist by training, but very interested in the area. I was intrigued by Geoffrey Wood's, I think it was a study with Forrest, pointing out to me what I had forgotten, although I lived through the era, that really there were no established sort of international capital requirements, and certainly not even in this country, I think, until the 1980s. Is that correct?
It is correct.
Yeah.
But
are you
I'll now put in a caveat.
Yeah.
Put in a caveat. The Basel rules began in the late 1980s, and they began curiously because British and American banks in London resented the very low capital asset ratios of Japanese banks, which enabled them to underprice their business.
Right.
The Japanese banks then had a torrid 25 years, so there we are. But that was the beginning of the Basel rules. My view about this is, and in fact in Britain, there was no legal definition of a bank until 1979, the 1979 Banking Act, and no formal capital rules for clearing banks and merchant banks as they then were, none were published. Now, in fact, all banks did report their capital to the Bank of England. Why? Because they might at times require loans themselves, and every banker is entitled to know what's going on in your balance sheet. You know, if a company goes to its clearing bank and says we want a loan, the clearing bank will say, what's the collateral, we want to see your business. If a commercial bank, clearing bank, whatever, goes to the central bank and says we want a loan, which happens from time to time, happened of course in 2007, the Bank is entirely justified in saying we need to know what your business is like, and we want to see your balance sheet, etc. And you put up some collateral too. What this meant was that in practice, British banks did report their capital positions to the Bank of England. You may remember, we're both old enough to know that there was this era of hidden capital, that there were supposed to be hidden reserves in the banking system. That kind of hocus pocus finished in the 1970s, 1980s. But it's all part of the mystique of British banking. You were not supposed, as a member of the public, to really know how strong these institutions were. Right. Now, in practice, the Bank of England did know, and there was one particular type of organisation, discount houses, that actually had a rule that was clearly, specifically about their capital. In the early 1970s, there was the rule that, in fact, their capital should be 2.5% of their assets. Now, did you hear what I just said? 2.5% of their assets. They were geared 40 times. Yeah. The notion that there's something inherently wrong about a bank being, I don't know, a clearing bank should be geared like that. But the investment bank that can hedge its assets, yes, they can be geared like that without that much risk. They go on decade after decade and make lots of money for the shareholders and management, of course, but actually that, not unusual, goes back a long way. Now, when we come to this crisis, the obsession with bank capitalization became extreme. And there was this, the bankers have caused this. The bankers have caused this because they've been irresponsible. Therefore, we must force them to have much more capital. This is what then caused Mervyn King, Ben Bernanke, a whole troop of them, to demand that banks have higher capital asset ratios beginning in October 2008, but then this pressure carried on and continues to this day. If you ask a bank to have higher capital asset ratios and they can't increase their capital, obviously what has to happen is the assets have got to go down. If the assets go down, then so do the liabilities. The liabilities are dominated by bank deposits, which are money. What you therefore do by raising the capital asset ratio, by the regulators imposing this big mandatory increase in capital asset ratios, is to do something that is very deflationary, and it was done at the worst point in the cycle. That is what was behind the Great Recession. And that's really the point of this book. What is incredible to me is this really quite simple argument. I'd say unique to me, it isn't. Many people say when I explain it, it's just obvious. However, there is practical unanimity among economists, regulators, central bankers, a lot of them, that actually bankers were to blame, and part of the answer was indeed an increase in banks' capital asset ratios. And as I say, the point of this is not unanimous.
Further questions? May I just make a point, Tim, and a question as well? Because when you said that money matters, well, you can clarify it if you wish, but obviously it's that for monetary policy purposes, for making monetary policy decisions, we need to analyze, to observe what's going on in money markets and how broad money is changing and how changes in broad money is affecting prices in the economy, consumer prices and financial prices and asset prices, and the overall economy. So which are the policy lessons that can be drawn of the book, in your opinion?
Well, I think one of the things that I have trouble with is that, you see, I've had this debate about these issues many times, and many people say that in 2008 the banks couldn't borrow the interbank market because the interbank market was closed. Again, these are very technical issues, and I know that many people here are not into the details and so on. I think what many of these people then thought was that if the interbank market is closed, then these banks can't grow. But that raises the question of where does the interbank market get its money from? One of the points to make here is that banks create money out of thin air. This comes as a great shock to many people, but they create it out of thin air. They just add identical sums to both sides of their balance sheets. They can't do this without limit. They must have some cash, in case they start losing some cash at the clearing. Again, I know it's very technical, we taught this in the MSc. And they must have some capital, I don't dispute that. So the process is constrained, but then they can indeed create money out of thin air. The interbank market is only one source of funding for asset expansion. And through 2008, European banks were in fact growing their loan assets faster than in 2007. There was no great problem in Europe, largely because of the ECB being so helpful. What I find is this confusion between this idea that banks have got a problem and this then means the economy must collapse. No. To most people, to most companies, to most financial institutions, what matters in their relationship with the banking system is the level of their bank deposits, their money holdings. And there were some problems, but the money slowed down through to spring, summer 2008 wasn't that dramatic, not out of line with the previous cyclical experience. What caused this collapse in money, certainly in Europe, was indeed the change in capital rules. And that was imposed on the banking system, on the private sector, by officialdom. The quantity of money matters because if I'm running a company, what do I do every week? I check the bank statement. You know, we just had a meeting this week of the trustee meeting. We checked the bank statement. If you're running a financial institution, you're running some assets, you're comparing the cash assets with the non-cash assets because the cash assets are poor assets that give you poor return in the long run. So if, you know, all companies, all financial institutions, all households find their money balances squeezed, you will have a crash in asset prices, etc. And this is hardly new. What is incredible is that in the run-up to the crisis, most economists, most central bankers and most regulators were not interested in monetary economics, and certainly interested in the quantity theory of money at all.
Well, unless there's any other question, I wanted to thank you very much, Tim, for being here today to make this very interesting presentation and the discussion of the topics in the book. And if you want to know more about the book, obviously you have the chance today to buy it. And if you want to know more about the effects of bank regulation on how banks are able to create money and the effects on the overall economy, please join us in our next public lecture on the 7th of November, followed by a conference on the 8th on bank regulation and on the limits of bank regulation, basically. So thank you very much again, Tim, for...
And by the way, if I just say, all MSc students at the University of Buckingham, all students taking the MSc in money, banking and central banking, will receive this book free.
Yes, indeed.
So
They will do.
Great.
So thank you
and
very much.
indeed all subsequent books in this series.
Thank you.